everyone, and thank you for watching my videos. In the previous videos, I showed you how the technical indicators in your trading platforms can give us really great technical analysis, which will give us an advantage when we're investing in the Forex market. And in the previous video, we looked at pivot points, and we also learned how pivot points can give us a little bit of sentiment analysis, as well as another video that I showed you on Japanese candlestick charting patterns. So by now we've learned how we can read charts, and now in this video we're going to learn how to read waves. You see, waves are important because when we look at the charts that are either in the finance section of our local newspapers or the charts that we see on TV when they report on the performance of the Dow Jones and NASDAQ, we notice that the lines on the charts, they move in waves. And these waves are important. So what I want to do now is I want to emphasize just how important reading the waves on a chart are. Okay, so here's some information that we need to know about Elliot wave theory. It was developed in the 1920s by a man named Mr. Ralph Nelson Elliot. He also analyzed many different charts and realized that the waves on the charts are set up in similar patterns. And by reading these patterns, we can learn about how people feel about the market. So again, we're talking sentiment analysis here. So, and it's also very important to make our investments based on how people feel about this market. Now, let's talk about the word fractal. What is a fractal? It means you take an entire piece of something, and when you break it up, those pieces are the same as the whole. For example, we look at this fern leaf on the left, snowflakes in the middle, and lightning bolt on the right. If you were to take any of these and break them into smaller pieces, those pieces would be the same as a whole. For example, if you take a lightning bolt and you chopped up the lightning bolt into smaller pieces, guess what? Those smaller pieces are still going to be lightning bolts. You're just going to have smaller and more lightning bolts. That's what a fractal is. We're talking about pieces of a whole that are equivalent to the whole. And the waves on a chart are no different. So let's take a look at a typical wave in a bull market. We have 5 waves. Wave number 1 shoots the market upward, and then wave number 2 retraces. Wave number 3 shoots the market up even more. Wave number 4 retraces, and then wave number 5 continues that bullish trend. So the 5 waves are called impulse waves. The waves that are going up in the same direction are the impulse waves, and waves 2 and 4 are the corrective waves. Now, according to the theory by Mr. Elliot, he realized that in wave number 1, that's the beginning of the bull market. Now, let's just say bull market because the market is going up. This also applies to the bear market as well. Okay, so it works like this. We have many investors around the world that have studied a currency pair. And through technical analysis, fundamental analysis, and sentiment analysis, they were able to determine that this market is going to go up. So, using that knowledge, we have millions of investors jumping into this market. And by doing that, that raises the prices upward. However, there is a limit to the number of investors who realize that an opportunity is about to take place. And once that number runs out, some of them are going to close their positions. Now remember, in the Forex market, we take both positions. We are always buying and selling at the same time. The only difference is, are we going long or are we going short? But we're always buying and selling at the same time. So it could be that the investors that saw the opportunity can, they are more than likely closing their positions and enjoying the profit that they made. However, wave number, okay, so wave number two, at this point, there was a limit on how many buyers were in the market. Now, wave number three, these are the people that have realized the opportunity. They saw what is happening. Unfortunately, they got in the market too late. But it's not too late to make a really good profit. So that's why wave number three is bigger than wave number one. And wave number three is usually the largest wave in the bull market because we're dealing with people that realize the opportunity and they're just rushing in because they know they're going to make a profit. However, there's still a limit to how many people have realized the opportunity. And once all of those people have open positions, what's going to happen is they're going to just close their positions because they want to enjoy the great decision that they made by going long. So that's what's happening in wave number four. So that's why waves 2 and 4 are corrective waves, because the market is suggesting that the price should not be going so high so fast. There has to be a limit as to how high the price could go. So that's why waves 2 and 4, they're correcting the price in this pair. But really what's happening is that the buyers are closing the positions because they want to get their profits now. Now let's move on to wave 5. Now wave 5, this is a panic wave because we have many investors that are full of regret and full of remorse, and they feel like they have to get into the market right now, so they're in a hurry, but they're not thinking that the opportunity is too late. They're just in a hurry, and usually what happens is the amount of profit that they can make is very small. It's like this. Let's say we have a store, and the store is selling a really hot product. So many people are coming in wanting to buy. However, you can only fit so many people in a store. Now, what happens when your store is full of buyers, but there's not enough room for any more buyers? Will people buy the products? No. However, once the buyers have left the store, making room for more buyers, then people will continue to buy more and more. So you see, the bull market is not a constant market. It doesn't go straight up. There is a limit to how far it can go up at once, and then the market holds at that position before it goes up again. That's why when you look at the stock market, the lines in the stock market look like this. Okay? So that's the answer to that question. That's why when you look at the stock market, it's not always a straight line up or a straight line down or a straight line across. You see, the reason why the lines are so jagged, it's the psychology of the investors. So remember that. Okay, so what happens after wave 5? What happens after the panic buyers get in because they waited way too late and they're just so desperate to make a profit? Well, we have 3 waves that correct themselves. So now, here's what happens. Waves 1, 2, 3, 4, and 5, all of those waves are impulse waves. It's not just 1, 3, and 5 anymore. All 5 waves. And now we have wave A, wave B, and wave C. Those are the corrective waves. Corrective meaning the market should not be as high as it was. The market should be somewhat lower. Now, if we remember the video that I did on moving averages, with the moving average, it tells us where the market should be. Not where the market is right now, but where it should be. And if you remember, by using the moving average, many investors, when they see a gap between where the market is now and where the moving average is, the candlestick will tend to gravitate more towards that moving average. Many investors look at that, and that's how they plan their investment strategies. And that's what we're seeing right here. We're seeing a move towards where the market should be after a really strong trend. Now, that's what it looks like in a bull market. And again, we call this the ABC correction. So we're not dealing with numbers at this point. These waves, these special waves, are trying to correct what has happened in the bull market, which is the price went too high. And this is what it looks like in the bear market, just the opposite. So we have investors who have done their homework and they saw what's going to happen in the future. That makes up wave one. Wave number three, many people are seeing an opportunity to go short, so they jump into the currency pair to get that big profit. And then in wave four, the sellers are closing their positions, getting their profit, enjoying their profit. And again, waves 2 and 4, they're correcting the market because the volume should not be as low as it is. So we got to get back to where the market should be, moving averages. And then wave number 5, that's self-explanatory, just how I explained it in the previous slide. Now, there are many different types of corrective patterns. Now, not the A, B, and C that I showed before, that's just one example, but here are some more examples. So we have the zigzag formation, the zigzag foundation. We also have the flat foundation. We also have the triangle foundation. Now this goes back to the lesson that I did on candlestick patterns. So we have the triangle pattern too. So we're using wave patterns and the candlestick pattern. So this is an example of why we need to combine tools, not just use one. Waves within a wave. So as we can see, as I explained before, waves 1, 3, and 5 are the impulse waves. Waves 2 and 4 are the corrective waves. And then when we have the 3 waves after the wave 5, now the waves 1, 2, 3, and 4, 5, now those are the impulse waves. Waves A, B, and C are the corrective waves. And then after waves A, B, and C, the uptrend just may resume. So keep that in mind too. And also, these are the different names of each waves. Now, I just want to take some time to reiterate the fact that these waves are just like the fractals that I explained to you in the beginning of the video, where we can take the whole of something, break it up, and then still have parts that equal the whole. So as we can see, waves are important when we're studying in either this market, the Forex market, or in the stock market, commodities market, or just reading the indices such as Dow, Nikkei, FTSE, or DAX. Waves are important because waves give us an idea as to how people are feeling about the market. So again, we're dealing with researchers who know the market. We're dealing with people who pick up on opportunities really quick. And then we're dealing with people that are so desperate for a good investment who got in too late and there's not enough room to make a profit. So the buyers, they just quit, or the sellers, they just quit. Okay, so here's what the waves within a wave look like on a real candlestick chart. So as we can see, this is what we're going to see when we open up our trading platforms. Our charts are going to look like this. So in this video, take this time to study the different wave patterns. And when we activate our demo accounts with the brokers that we choose, study the wave patterns on those charts, because that can yield some very valuable information, and that will give you a tremendous advantage when you're investing in this market. Okay, so here are 3 rules for using Elliott waves. I'll go through these quickly. Wave number 3 can never be the shortest impulse wave, because remember, the first wave makes up the people who know this market and they're experts in this market. Those are the people that set the trend. Wave number 3 consists of people who are knowledgeable about the market, but they don't have that deep knowledge that the professionals have. Wave number 5 consists of people who don't know much about the market, but they're just going on some advice that they might have heard in yesterday's newspaper or from some broker that they don't know too well. So they get in very late. So wave number 3, those are the people that see the opportunity and they want to get their profit. So wave number 2 can never go beyond the start of wave number 1. If it does, then the trend is not for real. And wave number 4 can never cross into the same price area as wave number 1. Meaning that second corrective wave is never in the range of wave number 1. It has to stay higher than wave number 1 in the bull market or lower than wave number 1 in the bear market. So keep that in mind. Okay, so other guidelines to remember. So sometimes wave number 5 does not move beyond wave number 3. Okay, so wave number 5 can actually consist of many people who are not knowledgeable about the market and don't realize that it's too late to make a profit. There are many people like that. And that could be the reason why wave number 1 is smaller than wave number 3 and wave number 5. So the smaller wave is usually the people that know that there is a big opportunity in the future. And it's kind of like that in life, right? The people that are very successful are the people that grasp the opportunity before anyone else does. It's always that first person that has the idea that no one else has. So, and there are plenty of stories, and I don't think I have to remind you that there are people who have those opportunities and grasp them quickly. Okay, so let's talk about how to use Elliott waves. So here we have a 5-wave pattern, and then after that 5th wave, the market seems to flat out some. And here we have what appears to be a rectangular formation at the end of a downtrend. So what's going to happen? Well, some people think that we might have a potential sell because that line of support as the market was heading in a rectangular direction has been breached. So some people might think that we should go short in this pair. Now again, it's up to you, but I'm just giving you an idea as to what most investors will do. So after a downtrend and the market moves in a sideways direction and we have 2 parallel lines of support and resistance, many investors are more likely to go short on this pair. So that's one way of using Elliott waves, and here's another example. So here we have what appears to be the beginning of one wave, because as we can see, the market was flat at some time. So maybe some of the experts have saw an opportunity real early, so they kind of want to set the trend. And then here we have a reversal because some of those investors, they want to close their positions and enjoy their profit. So here we have some retracements. So another thing about retracements, and I've mentioned this many times since the lesson on the Fibonacci, when we see a retracement in the bull market, it's not necessarily the sellers stepping in to try and reverse the trend. It could be the sellers stepping in to reverse the trend. It just means that the bulls are happy with pushing their prices upward successfully, that they want to enjoy the profits that they're making by closing, which gives the impression that the sellers are stepping in to change the direction, which is not always true. And with the Elliott waves, we have now learned that there is more than one possibility as to why the market does reverse itself when it hits a certain level. So again, we're going back to the Fibonacci retracements, and we're going back to pivot points. So now we should have an understanding as to why markets reverse themselves. So again, what happens when we go long using the Elliott wave? So we have the wave 1. We see that a trend has begun, and it's a fresh bullish trend, and then the reversal. So should we go long? What do you think? And we were correct. Wave 1, wave 2, and if we notice, the second wave doesn't go down so far, and now we've used waves, and we're using we're using pivot points, and actually we're using Fibonacci retracements. So here's an example of how we can use Elliott waves with Fibonacci or with pivot points, but in this case they're using Fibonacci retracements. And as it hits one of the lines of support that was indicated by the Fibonacci retracements, wave 3 has begun. Now remember, millions of investors around the world are looking at exactly what you're looking at, so they're probably thinking what you're thinking. So here's another example of using Elliott waves in a bearish market. So as we can see, the market has been ranging for some time, and here we have the candlesticks moving in between two parallel lines of support and resistance. However, that line of resistance has been breached a couple of times, and here we have a fresh new bearish trend. Now, here's what we've learned so far about Elliott waves. We've learned that Elliott waves are fractals. We can break up the waves and they'll still be waves. Or we can take a wave, add it to another wave, add it to more waves, and then create a bigger wave, which is the same as the pieces. And then also, when markets move in trends, they move in a 5-3 pattern. 1 is up, 2 is down a little bit, 3 is up, 4 is down a little bit, and then wave 5 goes up. Same thing in the bearish market. Wave 1 is down, wave 2 goes up a little bit. Wave 3 goes down, wave 4 goes up a little bit. And then we have that 5th wave. And then after the 5th wave, the market corrects itself. And sometimes those 3 waves after wave 5 becomes wave 2. And then at the end of wave 5, that whole 5-3 pattern becomes wave 1. So that's also what we've learned so far. So now, let's talk about harmonic price patterns. So here's what we need to know about harmonic price patterns. They help spot they both help spot possible retracement of recent trends. And when we combine this with other wonderful tools, we can get an even more understanding of what's happening in this currency pair, and that gives us an advantage. So here are many different types of patterns that we're going to discuss. The ABCD pattern, the 3-dive pattern, the Gartley pattern, crab, bat, and butterfly patterns. And now, let's see what they look like. As we can see with the ABCD pattern, now I have 2 examples, a bearish and a bullish. Now, let's look at the bearish ABCD pattern. Now, this is what we see after wave 5 of the downtrend. So here we have a little retracement. Now, if you notice, wave A, from wave A to wave B, the market retraces itself. So it begins the corrective trend And then notice from point B to point C, the market also continues that corrective trend, even though it retraces. Now, if you compare where point A and point C are at, we do have a perfect Fibonacci retracement of 61.8%. And then again, we have another wave from point C to point D, and if we were to measure from point B to point D, we have a perfect Fibonacci extension of 1.272. So Fibonacci is very important when we're reading Elliott waves. Remember that. And this can even give us an opportunity to sell. Just like we have a bullish ABCD, again, we're focusing on the corrective wave pattern. So these waves that we're looking at right here, these could be the wave 2s or the wave 4s of the respective patterns. So again, when we see a wave 2 in the bullish trend, and on the bottom here of this bullish trend, that's a clear buying signal. So think about that when we're looking at a wave 2 or a wave 4. We can pick up a buying signal easily if we're in the bullish trend, or we can pick up a selling signal easy when we're dealing with a bearish trend. So as we can see, in the corrective wave patterns, we have the legs. So the legs, that represents the two waves that are going opposite of the trend. And that actually begins the correction mode. So we do want to keep that in mind, that many investors, they're looking at that smaller corrective wave carefully to determine when the trend will continue, or how long will the correction continue to correct itself. So again, we have the legs, and then we have the point of correction. Now, let's look at the 3 dive. The 3 dive looks like this. So here we have a wave that appears to be moving in a steady direction. That is correcting itself. And again, we're reading Fibonacci. So here we have a perfect Fibonacci retracement of 0.618, as well as a perfect Fibonacci extension of 1.272. So we're using Fibonacci to determine when this corrective wave will end and when the trend will resume. So again, we combine tools. We're combining Fibonacci, or we can use pivot points as well, and we're combining these with wave patterns. Now, here's an example of the Gartley and the animals. Now, we call these the animals because a trader named Gartley, he studied corrective waves carefully, and he determined that some of the corrective wave patterns kind of look like animals. So I just thought I'd show them to you in this video. So, well, first, this is not an animal pattern. Here we have the 222 pattern, which includes the basic ABCD pattern that I showed you before, but they normally form when a correction of the overall trend is taking place. So, for example, here we have the bearish Gartley, and it's similar to the ABCD pattern, only it just means that here it follows a really long wave downward, or a long wave upward, depending on which trend we're following. And then also we are focusing on the Fibonacci again, but this time it appears that when we compare the volume at point A and volume at point C, it has crossed over 2 or 3 lines of resistance. So, I mean 2 or 3 Fibonacci lines, excuse me, as we can see with the 38.2%. So keep that in mind. We're not always dealing with the 0.618 or the 1.27, because again, lines are not exact. So corrective waves can cross more than one line of resistance or more than one line of support. Okay, so here's what the crab looks like. So I'm not going to get into too many details as to the shape, but the differences between these patterns involves the Fibonacci retracements and also which lines of support and resistance are broken. So that's really not important when we're looking at these types of waves, but it is important to understand how Fibonacci plays an important role when we're analyzing these wave patterns. So moving on to the bat. So it just means that the wave from C to D is longer than the waves from A to B and B to C. However, there is some symmetry in regards to the distance in regarding the teachings of Fibonacci. And then the butterfly, of course. Now the thing about the butterfly is, again, just like the previous patterns, we have the bearish version and the bullish version. But again, we're just dealing with how far apart the points are, how long the waves are, according to the ratio, the Fibonacci ratios. So here's just some quick notes that we need to know about the butterfly. So move 1A should be below 0.786 on the retracement. And also BC can either be at the 0.382 or the 0.886 retracement. And also, if the retracement of move BC is 3.82 of move AB, and then CD should be 1.618 extension of move BC. So again, the only difference between these patterns is just the amount of retracement and the amount of extensions. So 3 steps in trading harmonic price patterns. So here's how we use this in our investment strategies. So step 1, locate a potential harmonic price pattern. So here we have what appears to be a wave correcting itself. And then step 2, measure the potential harmonic price pattern. So we apply the Fibonacci numbers and we can have an idea as to where a line of support and resistance might be. And then step 3, buy and sell at the completion of the harmonic price pattern. So it's very important to know where the price pattern ends, because when we know exactly where the price ends, then investors will get involved in the position in order for the market to go the opposite way. And here we've been able to pinpoint where point D is, and from point D we know that the market will then reverse itself, and we were very successful. However, there is some flaws with this theory. The problem with harmonic price patterns is that they are so perfect that they're just so difficult to spot. However, more than knowing the steps, you need to know the potential harmonic price patterns. That way, you'll know not to follow the wrong ones. So take some time before we apply this into our investment strategies. Take some time to study the different types of patterns before we actually use them. And if we are going to use them in your demo account first, so you don't get burned when we're trading with real money. So, in summary, we've learned that harmonic price patterns can enable us to distinguish possible areas of continuation, and again, harmonic price patterns, they can be so perfect, but yet so difficult to spot. So study those patterns carefully. Take some time before we actually enter the markets. So again, we also understand that with the Elliot waves, we have an idea as to how the millions of investors are feeling when they look at this chart. Because again, when we read the Wall Street Journal and we see these charts and we see how jagged they are, and we know by now why they're jagged and not why they're straight. Investors, they develop emotions based on what they see. And what we're doing is we're playing on those emotions. And by playing on those emotions, that is how we use sentiment analysis. So far in these videos, I've been spending a lot of time talking about technical analysis. And now we're moving onto sentiment analysis. And now we can see how everything is starting to come together. The technical analysis, the fundamental analysis. Now, I know I didn't mention fundamental analysis in the previous videos yet. I will in future videos. But with fundamental analysis, we see that when we use our moving averages and our MACD, and how some of the sessions can have some fake outs. It could be that during that session, the government has released some information that put that pair out of whack. However, investors stepped in and adjusted their positions, and the market corrected itself. So that could be an example of fundamental analysis. But we've spent a lot of time in this video talking about sentiment analysis. So again, take this information that we've studied in this video with all the other videos and use all of these tools with each other. And that is how we get our advantage, and that is how we achieve our success in this market. Thank you for watching my videos, and good trading.